You sit in Oslo looking closely at European tech. Given macro conditions right now, how healthy is the technology sector from a private marketeer's perspective?
Well, it depends on what perspective you're looking at from, of course. I mean, we are looking at it from sort of fundamental perspective, which is, the digitalization and decarbonization is eating up an ever larger share of GNP. And if you want to invest in growth, that's where you want to be. And for us, that have been doing this for 20 years, having some of these sort of what we call digital tourists or private market tourists to retract from the market, I think creates a healthier and more exciting balance as an investor. So we see fantastic opportunity sets around us. Our portfolio, we're in the growth segment, right? We're not in the sort of VC ecosystem. We're not really in the leveraged buyout world. We're in the growth ecosystem, and our companies have on average grown about 20% per year for the last 20 years, returned 3.8 times and 61% IRR. And last year they actually grew 26%. So it's healthy underlying growth, structural thematics keep going, and a more sort of healthy and stable valuation environment, I think.
Here in the United States, we're talking a lot about how the NASDAQ 100, tech-heavy index, lots of higher multiple software names, is heading for its second best quarter of the decade. There's a lot of discussion in the public markets about tech shares performance in Europe. How are you benchmarking portfolio companies in Europe, European startups, against that public sector performance we've seen recently?
We've always tried to be quite cautious in our valuations. We've had statistically about 80% uplifts from 3 quarters before exit at Verdane. We've had the same statistics. We actually are old enough that we sort of seen this record play a couple of times before. We saw it after the .com crisis, saw it after the financial crisis. This sort of period of where our benchmarks actually, where our valuations actually shaken out, and it's really that sort of very schizophrenic or inconsistent behavior is what you're seeing, both I think in the European tech stock world and in the private markets, that it's still this period of trying to figure out where the world is really headed. We're not that affected short term in our valuation parameters because we have such sort of deep discounts to public markets in our sort of holding values. But clearly when you're discussing with founders or the kind of bootstrapped companies we typically talk to, of course they're looking at those kind of indexes, right? And clearly it was a lot more tricky conversations to do proprietary investments when the Besimir Venture Cloud Index or the growth was at 16 times than is now. But I still think those sort of massive gyrations are still just adding to the confusion. I think we're going to see another 6 to 12 months before things sort of flush out. But mind you, we have more developers in Europe than the US. Where we play, sort of Northwestern Europe, is much more digitized economies than the US one. And so... Yes. And much less capital available. So we haven't had the same massive run up in valuations, and therefore there's not quite the same pressure downwards, I would say.
Well, you reflect on how many Northern European and even Eastern European tech talents make their way over to San Francisco, where I am. The debate across the Atlantic has been about the impact of the SVB collapse and a tightening of financial conditions. How did that play out for you in Europe? Was there a material impact to operating cash flow for your portfolio companies, and how has that impacted their kind of outlook for the rest of the year?
It was really quite interesting because in the US, SVB and particularly on the West Coast is such a sort of pillar of the community. We have 7 offices across Northwestern Europe, Scandinavia, UK, and it's really only the UK that was affected in a meaningful way. When we ran a survey of over 80 portfolio companies, there were really only 3 of them that banked with SVB. So, and none of the sort of the regional firms here did. So in Europe, it's largely sort of isolated to the UK, where SVB was important. But I think it's interesting to see that there's been an explosion in venture debt, particularly last year. It more or less doubled, according to some sources, into about 30 billion, and about a third of all venture money raised last year with venture debt. I think that source is going to dry up. For many reasons, not least the sort of SVB learnings, but also general interest rates and everything else going on. So I think that sort of reckoning, a little bit of sort of reckoning the new reality of new valuations in the private markets has been delayed by the availability of venture debt, and that will go down now.
Well, kind of crystallize that for me. You have offices across basically euro-denominated markets, mainland Europe, sterling-denominated in the UK, Corona-denominated. Where are the opportunities? How do you play that environment when it comes to investing in private technology companies?
No, so we basically try to identify niches or sub-niches. It could be, but typically areas where the Nordics and Northwestern beer drinking Europe is what we call ourselves. And basically, it's really interesting that when I remember I moved to the US in '97 to do my MBA, and I was shocked that it was still cash in use or checkbooks in use. Sorry, I moved back from my reunion 10 years later, and you're still using cash. So there's these very sort of digital environments, which is really interesting. We can use that as a laboratory to build global winners from. And interestingly, when you have something, a flatter salary structure, one of our big companies, for example, Easy Park, has 1.5 million parking transactions a day through the system. We have 10 million customers in the US now. We know them under the name Park Now. When we want to hire a developer, that actually costs almost double in Atlanta compared to Stockholm. So you have this perception that these are high cost economies, but it's actually quite cheap to build technology. But because blue collar is quite expensive, the return on deploying technology is very high. So that's often what we see, sort of B2B driven, SaaS, native, healthcare, those kind of stuff.